Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1412A, and today's date is October 30th, 2017, and the title of the episode is, It Has Begun, the Corporate Media Pushing the Agenda of a Crashing Economy. Now, before I get started, I just want to make an announcement. I uploaded an interview with Michael Pinto on Saturday. It is on the X22 Report Spotlight YouTube channel. So all you need to do is go over to YouTube, type in X22 Report Spotlight, and you'll see the interview there. Or you can come on over to the X22report.com site or the newsentinel.com site. Scroll down a little bit, look over to the right-hand side. You'll see the video there. You can play the interview right on the site. Or you can go to Steemit at steemit.com. Just type in steemit.com/@X22 Report. It'll bring you right to the interview. Let's get into the economic collapse financial news. Well, it looks like the economy is starting to break down. And as we know, we've been following the economy and how it's been deteriorating. And way back in a report, maybe in the beginning of this year, we mentioned that eventually the corporate media is going to blame this on Trump, and they're going to start playing up on how the economy is deteriorating, not doing well. And we're starting to see a lot of stories coming out now leading up to that fact. I mean, if we look at the Eurozone right now, the Eurozone economy appears to be slowing down. And as it enters its final quarter, it looks like things have really slowed. Now, the data firm IHS Markit has looked at the economy in the Eurozone. And they're saying, yes, it looks like, and they're looking at the Purchasing Managers Index for the Eurozone, based on the survey of 5,000 manufacturers and service providers. It looks like these numbers have fallen from 56.7 to 55.9 in October. And they're saying that as we move throughout this year, we're going to see this decline even further. And actually, the decline that they're seeing right now is, again, unexpected. And what we're seeing is not just here in the United States, but out in Europe, in Canada, Australia. I mean, we know that Sears has pretty much closed up shop in Canada. We're starting to see the real economy rear its ugly head. And there's nothing that the corporate media or the Fed or the U.S. government can do. Yes, they can manipulate the numbers. They can tell us that GDP was 3.0. They can tell us that the stock market is doing well. All they have to do is point to it and say, hey, look, the stock market's doing well. They can tell you that retail is doing well and everything's moving to online. But we know that this isn't true. Now, when we look at the economy here in the United States, we see incomes are declining. It hasn't stopped. And we see right now that the U.S. savings rate has crashed to a 10-year low. Now, think about why this is happening. First of all, a lot of people have maxed out their credit cards. A lot of people have lost their jobs. Wages are declining. They're taking part-time jobs, or they're living off whatever they have left in their savings. And people have to use this to survive. And what we're seeing right now is that the savings rate is declining quicker and quicker and quicker. Now, the last time that we saw people spend like this, where people went out and said, okay, I need to get the stuff that I need, was in August of 2009, where people took it out of their savings. They went out and said, okay, I can't wait any longer. I have no room left on my credit cards. I'm going to have to dip into my savings and go for it. Now, remember, back in August of 2009, the government unleashed cash for clunkers. Now, spending surged during that period of time. People went into their savings and they used their money. And the following month, well, guess what? Spending plummeted right after that. So what we're seeing right now is that people, they are doing whatever they possibly can to survive. And they're dipping into their savings. Now, think about this for another piece of information here. Homes in the United States, well, they have finally surpassed their prior all-time highs. Remember that bubble that we had back in 2006, 2007, 2008, and it popped? Well, we finally reached a point where we are higher than that. Now, we broke it down in other reports in different cities showing that, yes, we are way above those areas. But overall, if we look at Case-Shiller, we see that we are now above that area. Now, what we're looking at here is that people can't really afford these homes. They're just way too expensive. They don't have the down payment. They don't have the cash to put the down payment on. And it looks like the cash investors, the hedge funds, the investment companies, they are all backing out now. And when we look at this, there's a problem that while housing prices are once again hitting all-time highs every month, household incomes have failed to keep up. In fact, the blog, The Political Calculations, shows in the past 2 years there has been a distinct trend in home affordability or lack thereof. Now, when you hear this, you say, well, who's buying these homes? Well, we know it's the Chinese, and they're backing out. They're investing now in Belt and Road. We know it was hedge funds, investment companies. And what's happening right now is that things are rapidly falling apart because the everyday American has been sitting on the sideline. Because when you look at the overall affordability, the ratio of the trailing 12-month averages of median new home sale prices to median household income in the U.S. has risen to an all-time high of 5.454. In other words, the median new home in the U.S. has never been more affordable in terms of current income. That means people are not making enough and the housing prices are skyrocketing. This is a complete and utter disaster. And you know what happens when we see this. I mean, think about it. When did we see this before? Oh, that's right. The last housing bubble. We're repeating everything that we've already seen, except there's one problem. It's much worse now. All those people that weren't affected the last time, they're going to be affected this time. And all those people who were underwater back then and still held on to their homes, they might be affected once again. Those people who have lost their high-paying jobs, who can't find a job, well, they're not going to be as affected because they have learned how to adjust to not having or going out and purchasing. Those people who might still have their jobs and maybe they're not getting the cost of living raise, they're going to be in for a big shock. Now, I don't wish this on anyone. This is a terrible thing to happen. But we can see that we're heading in this direction. This is why we've been saying, even though you have a job or you have a part-time job or no job, you need to, put away whatever you possibly can. If it has to do with food, maybe it's not cash. If you have the cash, put away cash. If you have the cash, buy some gold and put away the cash. I mean, there's different levels, but you can get prepared. And if it's only food, water supplies, medical supplies, that's it. Now, we can see that the Wall Street banks, they are in trouble. The volume of leveraged loans, the riskiest loans Wall Street banks provide, has surged to 38% year over year and has already beaten the full year record set in 2013. Now, this is according to Deal Logic. And total of leveraged loans outstanding has reached about 1.25 trillion. 9 of the 10 largest banks in the leveraged loan business have already surpassed their 2016 full year totals. Now, this is including Bank of America, about 120 billion in leveraged loans so far this year. JP Morgan, about 110 billion. Goldman Sachs, about 79 billion. Barclays, about 72 billion. Of the top 10, only Wells Fargo, at 69 billion, is still lagging behind this year. Now, we could see that this is going to be a complete and utter disaster. Now, what do these banks do with these risky loans and things like that? Well, they package them up. And they've been packaging them up. I mean, they're at a record-breaking 8.3 billion so far this year. Just 6% below the full year total of 2016. Now, the borrowers are junk-rated over indebted companies. Leveraged loans are too risky for banks to keep on their balance sheet. So banks structure these loans, arrange them, and sell the structured products to loan mutual funds or ETFs so they can be moved into, yes, you're going to hear this right, retirement portfolios. Or they're repackaged into collateralized loan obligations. So we know what's going to happen with pensions. We know that their whole entire model is based around an interest rate of either 6, 7, or 8%, and they haven't been receiving that. Now they have these type of loans included. This whole thing is one gigantic domino maze. Once one domino falls, it hits the others, and it accelerates as it moves throughout the domino maze, and everything just completely falls apart. And this is what we're going to see. Now, the corporate media, they're already building up to this. Now, remember back during the recovery with Obama when they said, oh my God, 2.2% GDP, it's incredible, we're recovering. Oh my God, we hit 2.3% GDP, we're recovering. This is what a recovery looks like. Now, what's very interesting, we know that the government under Trump and the Federal Reserve, they're still manipulating all the data. Nothing has really changed. Now, they came out with this new GDP number, and they said the U.S. economy grew at a rate 3% in the third quarter. This came from the Commerce Department. Now, let's think about this. We hit 3%, and we've always been around 2%, and that's manipulated. We know 3% is manipulated. But all of a sudden, we hit 3%. Now, the corporate media is out there. You think they'd be clapping their hands going, oh my God, we finally hit 3% because we haven't done this all throughout Obama's recovery. We finally hit it. Incredible. Instead, they're saying that the U.S. economy isn't quite as strong as it looks. Now, let's think about this for a second. Why would they all of a sudden say this? They're saying that the gross domestic product, the measure used to represent the U.S. economy, expanded by 3% in the third quarter. That's the second straight quarter of growth above 2% pace that has persisted for much of the economic recovery, and it's well above the expectations of 2.6%. But there are a few important details, they say in the numbers, that the economists, including those at the Federal Reserve, will look at. Now they start bringing up things like the things that we've been talking about, which is kind of odd. They said one thing driving the number higher was a rise in business inventories. That could mean businesses are stocking up in anticipation of growth in demand, or it could mean that they're ready for harder times that are moving in. At the same time, investments in structures slumped by 5.2% and residential investments slipped by 6%. Also worrisome, personal disposable income rose just by 0.6%, adjusted for inflation. They said another worrisome sign, especially from the Fed's perspective, inflation, as measured by the Personal Consumption Expenditure Index, registered at 1.5% in the third quarter and just 1.3% excluding food and energy. Now, they're starting to bring up all these different signs that we should be looking at and we should be worried about. And they continued on with, well, maybe they're the jobs that are out there, they're not as strong as we thought. Maybe the manufacturing is not really producing the way it's really producing. And they're starting to bring up all these different things that we've been talking about for a very long time, but now they're discussing it openly with everyone saying, maybe we should have some type of concern that these numbers aren't true. And this tells us something. This tells us that they're trying to cover themselves. They're preparing and getting ready to say the economy really isn't doing that well. These numbers are completely fake. And they might be leading into this fact, or they might just be saying and building this up so when the economy comes down, and we know the Fed will bring it down, that they can just blame this on Trump. I mean, that's really what they're going to do. And they're already building this up because already we see out in Yahoo where they're saying that the market might be overvalued and maybe it's not going to go up any further, and maybe we're getting prepared for some type of downturn. We see this is coming out of Business Insider where the economy is not as strong as we all think it is. And it's amazing how they're coming out with all this information right now because we know, and we've been following it. We've been following GDP. We've been discussing over this huge period of time how these GDP numbers are completely manipulated. We've been talking about unemployment manipulation, not just here, but everyone else that's been looking at these numbers have delved into them and saying, these aren't really calculated correctly. If we look at John from Shadow Stats, he does the calculation without all the manipulation and shows that, unemployment is much, much higher than they're talking about. GDP is much, much lower than they're talking about. And we've been seeing that, the whole entire system is getting ready to implode. And it looks like the corporate media is starting to build up on this, starting to convince us that under Trump at this point that the economy is not going to continue. And remember, he hasn't really done anything. He hasn't brought back manufacturing. This is the same manipulation. This is the same economy that Obama handed off to him. There is no difference whatsoever. He did not make any changes at all. There's nothing that has been changed. So we're still running on autopilot, and he's done nothing. Now, we talked about the petro-yuan, and we talked about the petrodollar. And we know there's a lot of countries out there that have been sanctioned where they're turning towards the petro-yuan. And the petro-yuan is on the verge of becoming a reserve currency. Now, it's already considered a reserve currency because it's included in the SDR basket. And we have to remember, nothing lasts forever. If we go back in time, we can see that there was one time that Portugal was the reserve currency, Spain was the reserve currency, France was the reserve currency, Britain, right before the United States, was a reserve currency, the U.S. is currently the reserve currency, and now it looks like it's going to move to a different country. And we've been following this for a very long time. And we can see there's a lot of countries now that have been sanctioned or don't want to deal in the U.S. dollar. They're using the petro-yuan. Now, is it ready to go prime time, ready to go full steam ahead? Well, neither was the U.S. dollar until after the war. But they're preparing it and getting it ready. It's not something they started yesterday. This has been in the works for a very long time. Remember, the central banks, they don't care who has the reserve. It doesn't matter, as long as they can control the creation of the currency. And yes, there is a central bank, private Western central bank in China. They're integrated and they still are there. They're still controlling it. And they know that they had to duplicate everything that's been going on and move everything away from the U.S., just like they did prior to World War II, because they knew that eventually the U.S. was going to be the reserve currency. They always know what they're doing in advance. They just don't tell anyone. They do it very quietly, very stealth. And this is what we've been seeing right now. And it looks like they're preparing this. Now, does this mean this is going to happen? No, we have a new player in town. That's a cryptocurrency, where there's a lot of different cryptocurrencies, and a lot of people would like to do without the central banks. But the central banks are trying to stay in power. So we can see at this point that the economies are completely falling apart. The corporate media is out there trying to convince us that the economy is not as strong as we think it is. We see the central banks have been preparing a new reserve currency. They're battling against a cryptocurrency. They want to take charge. They want to take charge of that. So we have all of this in play right now, and all of this has been going on for a very long time. This is why when we go through this next stage, this next phase of this reset, this is why you need to be prepared, because we don't know what's going to happen here with inflation. We don't know what's going to happen with the dollar as it loses value and how people are going to react. So you need to be ready and prepared for what is coming, and it looks like we're getting closer and closer to that point. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.